Well, on to a big spotlight for this evening, and the Organization of Petroleum Exporting Countries, or OPEC, has predicted in its latest report that global demand for oil will be less than previously expected. OPEC has in fact reduced its forecast demand for 2016 by 50,000 barrels per day. As consumption slows, this number could also be revised downwards, it adds. According to the report, OPEC pumped in 32.25 million barrels per day in 2016, a jump of 15,000 barrels from the previous month. The data comes ahead of that crucial meeting of producers that's going to take place in Doha on Sunday. Producers are likely to discuss a freeze in output at January's levels to try and tackle the supply glut. However, speaking to a Saudi newspaper today, the country's oil minister ruled out a production cut, saying, and I quote, "Forget about this topic," unquote. So pretty much still being somewhat cryptic. In fact, let's hear out some experts with their expectations from the upcoming Doha meet.
Even though there's some aspects of this that I have to respect. Yesterday did represent a technical breakout, for example, on the chart. But I think this is going to be, to channel Saddam Hussein's old phrase, this is going to be the mother of all buy the rumor, sell the news events here on Sunday. I think there's no way they come across with any kind of a deal or sufficient rhetoric to satisfy this rally right now. And I think there'll be a pullback starting next week.
Ultimately, it's about the supply-demand imbalance coming back in and meeting. And ultimately, when you look forward, there is, I suppose, an improving probability that that supply-demand will become balanced at some point in 2017. And of course, the markets respond to that much sooner, and that's where we're seeing the move higher in price at the moment.
In terms of oil demand, that is still a concern given the macro backdrop, given the fact that the IMF has recently revised its global GDP forecast as well. The thing that's helping oil on the fundamental side is supply, whether it be OPEC supply or non-OPEC supply. This is where the tightness is coming from in the market.
And for more on that, I'm now joined by Abhishek Deshpande, the Chief Oil Analyst at Natixis, who's coming to us now live from London. Hi, Abhishek. Thank you very much for joining us here on The Big Picture. Tell us, what are your expectations, really, Abhishek? Because clearly, we're getting mixed signals ahead of that crucial Sunday meeting. In fact, now there are also some reports saying that Iran may not even be sending their representative, their oil minister, to the meeting, but they'll only be sending a representative. So realistically speaking, is there anything to be hopeful about that Sunday meeting?
Well, first of all, let me say one thing, that usually in the last couple of years, we have seen this kind of oil price volatility and oil price on various speculations just 4 to 5 days before the OPEC meeting. So this is not surprising at all that every time you hear some comment from different delegates, you will see prices reacting either upwards or downwards to that just before the OPEC meeting. Now, as far as our expectations are concerned at Natixis, we remain skeptical. The probability still is quite low on them trying to achieve a freeze that includes Iran in that particular freeze. As we know very clearly that Iran does want to come back and increase its production to levels of 4 million barrels per day. So it remains extremely difficult to expect Iran to agree to such a freeze. And freeze outside or excluding Iran would not be enough to tighten the physical balances, to be honest, but they will tighten it slightly.
Right. So therefore, you're saying that the very basis of optimism that many commentators are still sort of clinging on to, saying that there might just be some sort of an agreement. So the very basis of that optimism, which as you rightly pointed out, Saudi Arabia and Iran's interests being in some sort of congruence, is then perhaps completely misplaced.
Totally, and in fact, we are finding it extremely difficult why those two countries, to be honest, who have got absolutely different agenda in many ways. One which wants to increase its production to optimal levels, which is Iran, and Saudi Arabia, which is producing above its optimal level, wants equal contribution from every other member, and also non-OPEC. Don't forget that. So it's difficult how these countries will suddenly, in a matter of next 3 to 4 days, resolve these issues before meeting in Doha.
So then tell us, according to your own analysis, where do you see the oil prices heading from here? I know that's a difficult question, but then if you can just also give us your rationale for for your midterm forecast for the oil prices.
Well, if there was no agreement, let's say on Sunday, then of course we will see the impact of that on oil prices, with prices even falling from where we have seen in terms of rally in the last couple of weeks to over a month now, which was driven by investors predominantly, according to us. So we will see prices coming off, and possibly then we are looking at our based on our base case scenario of oil prices closer to averaging $38.5 this year and 48 next year, with prices of course rising towards the end of the year and then towards the end of next year to $50 or so. And medium term, we are really looking, realistically speaking, that the markets will be actually unbalanced this time around because of supply not being enough by 2017 and 18 to meet the gradual increases in demand. And by then you will need prices above $60 to $70 from the incremental barrel or the marginal barrel to meet those incremental demand that is required by 17-18.
So fair enough. So then essentially you're saying that in the medium term, one does not need to worry about the kind of lows that oil prices hit in the recent past. The 52-week low. In fact, just now we were flashing it also on our screen when the oil prices went down to as low as $29 a barrel. So you don't see that sort of a scenario being, sort of panning out anytime soon.
Not at all. In fact, medium term, I think all the capex cuts that we have seen last year and this year, they have been quite significant, and they should really help balance the market. In fact, like I said, probably even tighten the supply-demand fundamentals by 17-18 to an extent where you may not have enough supply in terms of growth to meet the incremental demand. But it's really the near term which will remain extremely volatile, depending on, one, what decision is taken on Sunday, and also depending on how quickly US producers react to that decision on Sunday, because they have the ability, because of their short capex cycles, to bring back rigs if need be, if the prices were justified and were enough for them to continue producing and keeping them alive for the time being.
Well, there is a significant amount of gap right now between demand and supply, as even the commentators before you were, we were pointing out. But many would also say that currently we are facing a supply shortage in places like Iraq, in Nigeria, UAE, and of course, even the supply and the production of many of the non-OPEC members are being impacted. So do you think, putting them all together, do you see any sort of upward pressure on the oil prices because of these reasons that I've just now shared with you?
I agree that there have been outages, particularly in Iran, some time ago in Libya as well, and Nigeria as well, because of the sabotage. And those were, I would say, more or less like transitional supports rather than sustainable support to prices. Really speaking, in first and second quarter, we were still in excess supply of 1.5 to 1.7 million barrels per day. But what you have to look is forward-looking. So third and fourth quarter, this excess supply reduces significantly because of quarterly changes in demand, but also because of significant reduction in non-OPEC supply expected by third and fourth quarter. So we are looking at an excess of close to 300,000 at the most in our central scenario. So hence, there is more of a reason to believe that balances are on their way. I mean, markets are expected to balance, hopefully, towards the end of this year or at least by early next year, at least if in the case there was a freeze, even if they were excluding Iran out of it. If they did reach a freeze agreement, including Iran, then we can see markets balancing as early as third quarter this year.
Right. Abhishek, my final question then to you is, oil prices, of course, it impacts different countries in different ways. Of course, India stands to gain a lot when the oil prices are on the lower side. Yesterday, we saw the IMF clearly highlighting that the lower oil prices was impacting a revival in the global economy. We even had a guest on our show yesterday saying that how it has impacted manufacturing in the United States because shale production has, of course, hit a low. But in that sense, the larger question that I have for you really is that, in this case, when oil prices go through such a rough patch, do you feel that the benefits that it perhaps brings to countries like India are far and few when it is compared to the sort of the disastrous implications it has for rest of the global economy?
No, totally. I do agree that lower oil prices is positive, net positive, at least in the near term. So you really have to divide that into near term and medium term. In near term, or like 1 to 2 years, it's great, and we have already seen the positive impact of lower oil prices on net oil importing countries such as India, China, US, Europe. All these countries have shown positive, have shown improvements in growth, but also increases in their demand for oil products. Whereas the negative impact is for the net oil exporting countries, or commodity exporting countries in general, such as Brazil, Russia, and OPEC, Middle East countries. They are, of course, suffering. Some of these countries are also expected to go in recession or negative growth this year, such as Russia and Brazil. So we do see exactly the opposite ends of the spectrum. But in medium term, if the prices were to stay low for a longer period of time, that's when you start seeing the impact of that negatively on global economy. But for 1 to 2 years, it should be good.
All right. Thank you, Abhishek. Thank you so very much for joining us here on The Big Picture and taking us through all the various nuances and what possibly we could expect on Sunday. Thanks so much. It's time